So welcome to CoinFirm's second in our series of DeFi webinars. This one, we're going to go into the topic of the fine line behind software and service provider. We have an esteemed panel from fine legal backgrounds, and obviously with that, what we do have is, of course, first a disclaimer so that we can record this and potentially show it on demand as well. So the disclaimer is that obviously anything that gets broadcast, anything that goes across within this, these are personally held views by the panelists. They do not relate to the companies that they potentially represent, so please don't sue them. Also, we'll get this out of the way as well. This is, of course, hosted by CoinFirm, one of the leading AML analytics platforms in the space. CoinFirm, off the back of a very, very successful mission to help participants reclaim their crypto with the Reclaim Crypto service, has just launched Reclaim Fork, potentially allowing people to unlock millions of fork coins which have not been claimed previously. So there we go, corporate shill out the way, disclaimer, we're good to go to get into the meaty stuff. I thought it would be great if we could perhaps go across the panel and just do a few introductions so we can understand a little bit more about why you're here, what your angle is, and what you guys are working on, and perhaps maybe putting you on the spot, a couple of lines about what DeFi means to you as well. So on my screen, let's go left to right. So Joey Garcia, it'd be great to hear a bit about yourself.
Great. No, so I'm a lawyer, hopefully some of you will know, based down in Gibraltar. I'm also director of the Zappo group of companies, so on the bank and on the VASP side of things. And separately to that, IOV and RSK, the sort of smart contract layer built on the BTC protocol, etc. So that's a very direct touch point, and obviously an advisor to a number of groups and platforms in the space. And I'm also part of the United Nations ODC working group in Asia on this topic, actually quite specifically. And I've obviously historically been involved in the development of the framework in Gibraltar. So from that perspective, when we talk about DeFi, the assessment or analysis between what is caught within the regulatory, whatever we want to call it, FATF, VASP definition, and what is arguably carved outside of that is also a very hot topic on a multi-jurisdictional basis. So I hope that's broad enough.
Fantastic. So many different boards, many different angles, many different hats. Great. David, would you like to introduce yourself?
Sure. My name is David Silver from Silver Miller. I am also a lawyer like Joey. I do a different type of law. I represent victims who have had their cryptocurrency stolen. I got into this niche in about 2014 in a little case called against a small exchange called Crypsy. But in the last 6 years, I have lawsuits against Coinbase, Kraken, Bittrex, Poloniex, Zappo, Tezos, Nano, BitConnect, OneCoin, Monkey Capital. Over the last couple of months, or about the last year, I have over 100 different SIM swap cases, which in 2018 and 19 were probably the biggest problem in crypto, where every major player in crypto got their phone SIM swapped. And I've got about 100 lawsuits against AT&T, Verizon, T-Mobile. So I've got a little niche practice of helping people recover their crypto assets, and I've been working with CoinFirm on that.
Wonderful. David, you sound like the busiest man in crypto with that list of clients. Brilliant, thank you so much. And Josh, it would be great to hear about yourself.
Hi, I'm Josh Klayman. Thanks for having me here. I am senior counsel at a global law firm called Regulators, where I head our US FinTech practice, and I'm head of blockchain and digital assets. I also am one of our global tech sector co-heads. My practice is pretty broad. It generally involves representing digital native companies in a variety of different transactions, including fundraising and different other activities, as well as more traditional and large companies that are just looking to explore the digital asset space. In addition, I chair the legal working group of the Wall Street Blockchain Alliance, and I'm involved in a number of groups in the sector, including diversity in blockchain and also Node Women. So I'm very happy to be on this panel. And what DeFi means to me, I mean, I guess just using the words decentralized finance, but when I think about it, I think about when I first learned about blockchain and the idea of getting rid of financial intermediaries and others. And I think with DeFi, there's a lot of potential to do exactly that in more sophisticated ways. I guess one last disclaimer that I will tack on is nothing that we say is legal advice and nothing is investment advice.
Okay, wonderful. Thank you so much. And last but by no means least, especially as he's my boss, Pawel, do you want to introduce yourself?
Hi, I'm Pawel Kuskowski, CEO, co-founder of CoinFirm. For my sins in my previous experience, I'm actually a lawyer as well, a regulatory lawyer. So I spent several years in financial sector, especially in compliance and anti-money laundering. And this is the basis also for, why we built CoinFirm, actually, to help, recovering assets, to help preventing financial crime. And I work with a number of people, including David, on the assets recovery. And for the in terms of DeFi, DeFi for me, it's that's an extremely interesting area. I think that's another frontier for both how we revolutionize finance, and I think this is what's going to happen with. DeFi going to push for another frontier, but it's also another frontier of actually money laundering. So that's something which we need to balance in this conversation, I guess.
Absolutely. I think that's what we will certainly try to do. Thank you so much, guys, for your introductions. It seems that the amount of activities you guys are involved in, none of you actually sleep. Let's delve straight into it. It might be an easy narrative. But it is one that we often hear repeated. 2017, obviously, we had this huge rise in a thing called the ICOs. And if you go across the Twitter sphere, if you go across various other areas, there's a lot of similarities that people are pointing out in terms of this explosive growth that we've seen, and potentially that regulators may be seeing DeFi in a similar light. So what happened with the ICOs, a number of those didn't have a KYC, didn't have AML, didn't have product a lot of the time, certainly a lot didn't have users. And we saw a lot of judgments coming in from the SEC, seeing them as securities, getting them to pay back funds and what have you, generally shutting them down. Now recently, within sort of the space, we've actually seen a few other regulators come to the fore and a few other actions come into place. Most recently with a large mixing service where we saw FinCen look at things like the Bank Secrecy Act. So an open question, please do go wherever you'd like with this one. Is it now FinCen that's keeping up crypto founders at night in terms of potentially regulatory punishment rather than the SEC? So I'll start with Josh. Ladies first. If you'd like to unbundle that, take it where you'd like, and then others, if you would like to jump in on this and converse, I'm happy to step out the way. So Josh, I'll hand over to yourself.
Thanks, Ryan. So, just stepping back for a second, I think that one of the things in the digital asset space that we're known for is coming up with new catchphrases. Right? And this idea that once you develop a new catchphrase, maybe you've developed something new that regulations don't apply to. But generally speaking, while within the US there are some prescriptive laws, of course, a lot of the laws in the areas are principles-based, right? And so no matter what you call these new projects, these new group of things, they're still subject to the same analyses and the same laws. So I do think, certainly FinCen is an important regulator in the digital asset space. I think it should be keeping many people up at night, or at least people should be thinking about things when they're structuring their projects about how to comply, also with sanctions, also with many other types of things. But I don't think just because there was an enforcement action, it means that this is something that should be seen as new. Like, I think people should have been kept awake about a lot of things for a while. And I don't think that just because there have not been, to date, significant enforcement actions, potentially by, say, securities regulators, I don't think that means that they won't happen. I think we still need to look at things through the same lens of saying, if you're, just to say the securities thing for a second, is this offer and sale of a security, right? It's still used, no matter what you call it. You need to look at the particular facts and circumstances.
I mean, I'll just jump in around a minute. It's a really interesting question, but I think one of the things, and we can all be extremely negative, by the way, we could all theoretically be very, very, very negative, but I think sometimes when people now talk about DeFi, there's a bit of a sort of sway to the negative, and there's a lot of focus on what can go wrong, and the sort of Helix FinCen action is one of the things that people are raising a lot. And there's less of a focus on what can go right. So there are sort of these concepts, democratize financial inclusion, etc., all these wonderful concepts. The reality is, I think that, you know, the rhetoric can be very inspiring. I think the reality is not quite living up to that at the moment. I think that there is a lot of abuse. There are a lot of people that simply take the view that by attaching the word decentralization to anything, they're falling outside of the regulatory perimeter in every single jurisdiction in the world that they're operating in, and that's completely inaccurate as well. But what I would say is that, I mean, I think that there has to be, or there is going to be, I mean, the regulatory barrier to entry for a lot of innovative startup industries is very high. We can all think of the Skype and Uber, etc. examples, and sometimes aiming below that, but doing things correctly is the very obvious sort of direction of travel. So again, talking about the FinCen Helix case, you're talking about, you know, effectively a mixer tumbler style service that was marketing, you know, through the darker spaces of the internet as to how customers could anonymously use transactions to pay for drugs, guns, etc. That's a very, very negative, you know, very clear sort of message around what they were trying to do. That's not to say, I don't think it's to say that all regulatory authorities are now sort of looking at hard enforcement action as the way to regulate the space. I think that a lot of them are looking at conceptually, you know, what is this, and how can regulation apply to this as a technology? How can it apply to it as a principle? And they're looking at that and trying to understand. And I think I would put some of the regulatory authorities in that basket as well. We're not seeing massive swathes of enforcement actions. There are very open discussions with different bodies around the world as well. So I think it's a moving target, but one that, you know, needs to be approached very carefully.
So taking extension of what Joey's saying, I remember speaking at my first couple of conferences in 2016, and the ICO was just starting. There was one or two big ones in 16. They were mostly in 17, and I was sitting at the end of the dais, and everyone spoke. They were very big firms in the U.S., and they were all saying how this is an ICO, it's not a security, and all I said was, there's no such thing as an ICO. It's a made-up term to sound like IPO, to make it sound legitimate, and I got booed off the stage. I mean, literally, I was in New York and I got booed off the stage. I believe that from 2017 to the end of the ICO craze in 2018, 2019, what we learned is that the regulators are going to take low-hanging fruit. They're going to do legislation by decree. So they're not really bound by, you know, old law, old statutes. They didn't really pick fights with anyone that they couldn't win with. And then slowly in 2019 and 2020, we've seen the regulators step up who they're going after. Kick, you know, the Kick Foundation was one of those. I still believe there's another large one coming down the pipeline that a lot of people in the space know about that will eventually, you know, change the perception of what happened in the ICO craze. But what happened is the amount of money invested versus the amount of money lost, especially in the larger companies, it did open the regulators' eyes, but governments are slow to move. And I think the reason why we don't see harsh penalties, the government isn't out there to stifle innovation. They need to let the marketplace see how the marketplace is going to react. And I think the reason why FinCen and what we just saw with BitMEX, where the US is showing that they're going to go overseas and go after cryptocurrency exchanges, providers, service providers, that FinCen should keep people up at night. I think the KYC, AML compliance is going to be the next wave of these companies showing how they're legitimizing. And more importantly, I think that this is good. And I think this has also driven the DeFi boom. Now, I didn't give I think we were supposed to do word association on what DeFi means. I don't believe in DeFi. I believe DeFi exists, but I don't believe DeFi is going to exist in the mind of the regulators. Governments are never going to cede power to a decentralized authority that they can't in some way manage, control, legislate. So I think Uniswap, so I don't know the statistic. I'm sure someone on the panel can give us, but someone told me that there's more trading on Uniswap than Coinbase right now. And if that's true, that's a fact that would be a mind-numbing statistic because it shows you the power of what DeFi is capable of in a very short time. And I think there's going to be a lot of investigation into that moving forward.
I think it's also just to add to that, James. I mean, it's what is interesting as well is I think there's sort of two extremes. The one extreme sort of regulatory view might be, I don't really care about what technology this is. There's a contract or an asset that's been sold to an individual in this jurisdiction, and that was wrong. And I don't really care whether you can talk about CFI, DeFi, whatever you like. I'm looking at exposure of the consumer, and that's the trigger. And there are other extremes where they are. I mean, I think I read something about. I read something recently about the Aladdin, the BlackRock risk management platform. Manages sort of $20 trillion, 10% of the world's financial assets under one system. It's under a BlackRock system, but it hasn't a status, a legal status, a license, or a headquarters. It's not itself subject to financial regulation and supervision. So, there are infrastructures that are connected globally. In that example, they're owned by one asset management group. So technically, it's sort of decentralized in the way that it works, but economically and technologically, it's quite centralized. And there are regulators that understand that, and they're saying, this has to be controlled, but what is it that we want to regulate? Is it the protocol? Is it the developer? Is it the participant? Is it the operator? What is it that what doesn't work, in my mind anyway, is to try to squeeze an innovative new technology and apply legacy frameworks and standards to it in exactly the same way. The MiCA stuff that everyone's talking about now, this sort of operation of an exchange platform, a trigger, a requirement to incorporate a counterpart. So there has to be a legal entity, but in reality, some people, and again, I think it was Peter and Valkenberg who wrote something very interesting, and he was saying, when we talk about something that's truly decentralized, there is no counterpart. You can't really talk about a decentralized exchange. There's no such thing as a DEX. That's inaccurate. It's a verb. It should be a verb and not a noun. It's you make a decentralized exchange through this underlying technology. You don't use a decentralized exchange. There's no counterpart to that arrangement. But the reality is that, again, in the many examples, there are many examples. I mean, the Ether Delta one would be the most obvious, where you talk about a DEX, but the reality is that's not the way that it's operating at all. And actually, if you look at the FATF guidelines and you look at the MiCA standards or conceptual proposals, etc., I mean, that some of them are very directed at capturing that within, and they have very, very specific examples in their definitions and guidelines. And I think a lot of people haven't yet really understood that. They don't really see the regulation coming, and that's another problem with the ICO sort of example, which is very, very relevant. Although, again, what I wanted to add to what David was saying there is that I 100% agree, but it's a hugely evolved market that we're talking about today versus 2017. I mean, there's a much, much deeper understanding across the globe, across the regulatory and enforcement agencies and everyone else over what this technology is. I mean, if in 2017, I read this sort of Boston Consulting Group sort of paper yesterday or the day before on sort of the provision of banking of crypto depository services to from banks to the wider industry. I mean, that is not something that would have been written in 2017. That everyone is sort of moving in this direction of sort of accepting that this is happening and looking, I hope, at the right standards. And that's something that as an industry and as a group of practitioners, I think should all be encouraging. So doing things correctly and doing things the right way, but with the right level of controls only.
So just unbundling that. Sorry, I just unbundling that a little bit. I think David mentioned we've seen these volumes, right, which is something which is very, very different to the ICO area. You've got this huge amount of users. You're having volumes which are potentially significant to that of something like Coinbase. Everything is still experimental, yet everything is very, very high value. The stakes have been raised, it seems, this time round, because these things are being used, and there's significant amounts of money which is being transferred across various different actors. Maybe it'd be interesting to break down some of the components of what would appear to be decentralized and what would not be. So, going into things like the smart contract itself, non-custodial wallets, who actually has control. Josh, I know you probably do a huge amount of work on this side. What are the sort of the major things that, as I think it's clear, regulators will want to catch up in terms of how they view this, that they'll be considering as they sort of turn their attentions to DeFi?
I mean, you've touched on some of them. Is it okay if I back up just for a little bit? Because there was something like that I can tie together with what you've just said now, and also with what Joey and David were saying. I actually think that some of the move towards, personal view, and again, very pro digital asset space, obviously, but I think some of the move towards this decentralization is driven, frankly, by the guidance that was given with respect to like the SEC framework and how you determine that there's no active participant, right? Many people, rightly or wrongly, have decided, okay, well, I've looked at the framework and I've looked at the enforcement action against Zachary Coburn in connection with Ether Delta, right? And I see, okay, well, people were still relying on, notwithstanding that something might be said to be decentralized, that actually there was a person keeping an order book, right? There was somebody with a key, who could change things. And also when you look at the framework and the various questions that are asked to determine whether there's an active participant and whether someone can be relying on the efforts of others, I think this starts driving in the direction of, okay, so we're going to write a smart contract, we're going to release it, right? Like we are not going to be having material non-public information. We are producing this, we are giving it out, and then we are stepping back. And I think that's the position that some are taking. I think just to touch on one final thing relating to the prior question, and I guess this relates to this question too, is that one of the challenges is if you put something in place, if you have a smart contract that's released, and if you just, you step away from the project and you just let it live and evolve, to the extent that there's a change in law, this can be challenging, right? Even if you complied with the law at the outset, as you may know, just very recently, the Fed and FinCen proposed potentially lowering the threshold for international transactions for the collection and retention of data, right? Customer data, because evidently, they found a justification that a lot of the financial crimes were happening at lower dollar amounts. So I think just something to bear in mind. But as for the other things you were talking about, Ryan, yes, I do think things like custody and whether people are relying on a centralized body for custody or for order keeping or matching orders, things like that. I think this is all relevant. Whether there's any recourse to the individuals, I think you also look at whether the individual team continues to have material non-public information, whether they are holding tokens related to the project themselves, whether they have the ability to go in and change the code. All these sorts of things. So
it's a great time to bring Pawel in, I think, for maybe the other side of that conversation. So as you learned very well, Josh, a lot of these things, perpetual smart contracts, they're loose. It's wallet to wallet transactions. Once the initial code is gone, in theory, they can just continue on perpetually and no one can stop them. You can use IPFS potentially to host these things on the front end. But they do have big communities, these guys who deploy the smart contracts. And they do, build these things, they do release them. But Pawel, maybe you'd like to go into that a little bit further in terms of some of the other factors that you might want to consider.
I think, there's, I mean, there was so many questions around, how you approach this. It's almost like you can, make it similar to, is producer of a gun responsible for killing someone, or, is producer of a car responsible for car accidents, all this stuff. I mean, we're going to see very interesting battles, I think, in the court, with the regulators. And I think, we're really going to see something, which is really, what I like about DeFi is like they are pushing the boundaries. This is something that is, going really, really well. And I always say, let's say if we're talking about Ethereum, is Ethereum sufficiently decentralized, or is Vitalik, so powerful that he can say something and this protocol will be changed accordingly? If we have the guy who cannot say how many tokens are in the circulations effectively, we don't know this. This is like, how quickly can he release this funds? How secure is MakerDAO, from being hacked? Is it someone responsible for this, hacks? Like, there's so many questions which we can, go into. From my perspective, it's always like, what these vehicles are being used for? What's the main objectives, right? Is this vehicle, is this, smart contract being used for good, in principle, like, settlement of different assets, exchange of different assets, market making, or is actually set up to disguise the funds, right? This is something, which is critical. What's the main objective, and what is real main objective? You could argue that many of the exchanges which are currently, in troubles, we could say like 3-4 years ago, they gonna be in troubles. They operated in the way you could understand immediately that the main goal is actually to, exit to the exit scam, for example, right? And I think exit scam is very interesting word because it does not exist somewhere else, I think, except crypto. Like, you plan to exit, you make a scam from this, and it's exit scam. So that's beautiful. So I think, we're gonna see this, how it's evolving, and what's the protection measures for this project? Are they taking this at least to some consideration, how they protect themselves from like being this vehicle to launder money, for example?
I think that, Pawel, what you're talking about, it is interesting because as these platforms and the industry develops, it's funny, you see some sort of leaders that are taking the right approach. They're thinking, what could this regulator or that regulator or some form of regulation be thinking about in terms of a standard? Should I be writing that into my practice and controls? Should I be building a compliance layer to a decentralized operation? Should I be putting in whatever it might be, transaction limits or ID systems or separate oracles, validating, whatever it might be? Some people are thinking that way, and some people are thinking a very different way. But the key, and when we talk about where the tests are, I think very broadly speaking, you can look at platforms where there's a real responsibility that sits with the user, and then the more decentralized it might be considered to be, and then the triggers for centralization, whether it relates to decision-making process, whether there's a by way of business argument, a monetization argument, a marketing, a solicitation, where it looks like there's an entity which is responsible in its, whatever we might call it, marketplace, then that's going to have triggers that need to be considered. And we're not sort of making this up. I mean, that's the other key thing. We're not sort of making legal speculation. If we look at literally the FATF guidance, which is defining the concept of a virtual asset service provider, and you look at their guidance as to what safekeeping and or administration of a virtual asset or an instrument enabling control over that asset, what that actually means, and you look at the control triggers within any smart contract platform, they are ultimately asking jurisdictions to legislate for capturing that activity. So there are many decentralized platforms that have very, very obvious layers of control, and some that don't. So it's more complex than saying if I operate in a decentralized way, or there is a peer-to-peer transaction system over a smart contract, I'm going to be unregulated. That's not right. But at the same time, I'm definitely a believer that there aren't necessarily centralized touch points to every platform or every DeFi system that exists. And that goes back. I mean, interesting when you look at the FATF stuff, which is relevant to all of us. That was published in June 2019. If you look at the FinCen guidance of May that year, it's very similar. It defined things in a very, very similar way. But again, some people aren't really aware of that, or they're not yet paying attention.
Joey, frankly, when you see, the biggest ICOs, right, the biggest exchanges which are operating right now, none of these projects started from, okay, how I can start with compliance, like no one. It's actually almost like you need to, I mean, we're going to see these DeFi projects which are breaking laws and then, paying, hefty amount to the lawyers, and then putting the right measures and controls. I think this is the way which going to happen. It's almost like this industry is actually make it break it and make it way.
Yeah, but Pawel, you also know that the ICOs that didn't conduct any sort of compliance or onboarding standard today find it impossible to deal with a bank or whatever it might be. And the consequences are always there somewhere further down the line. And I think there are some groups that prepare themselves very carefully and very well and very professionally, and there are others that don't. But they ultimately, I think, feel or bear the brunt of that somewhere down the line, I think.
I'll kind of go in the middle of what you and Pawel are saying on that, because I wholly agree with Joey's take on it. Let's use the primary ETH sale. There's no way that was not a sale of a security when they raised the first $40 million. Do I think that now, today, ETH is sufficiently decentralized? Probably. They're not going to be able to go back and unwind all these transactions on the Ethereum platform. But for certain, when things start, my metric for analysis on a lot of this is a little bit different. And this is why I say there's no such thing as a decentralized exchange. And the MyEther case is an example of this. If the exchange you're using takes a fee to do the transaction, someone is making money on that. Someone is making money on the use of that exchange. It cannot be a truly decentralized platform unless God, aka Satoshi, goes completely dark and does not take a fee and goes out through a different process. So I think the problem with the ICOs were that the ICOs, for instance, when they came out, there were people who made a lot of money. And if you're going to make a lot of money, you're subject to the rules, the law, and the regulators. So the easiest way to get around the ICO, the DeFi, and whatever comes next is if the creation of a process where there's not an exchange of money, then I will agree that there can be something sufficiently decentralized to allow that. The problem is most people, most businesses, most companies so far have attempted to retain a certain portion of the proceeds. And once you do that, you expose yourself to regulators, investors, lawyers, and everyone else involved. In order to not expose yourself, you have to be truly anonymous and not part of the process. So I think Josh, you said it earlier, if someone gifts the smart contract, walks away completely, and has nothing else to do with the evolution of that product, then that's a very different thing than an exchange, for instance, that claims to be a decentralized exchange from being part of the regulators, lawyers, and whatnot. What I find interesting is if you take Kraken, for instance, and I think Joey's talking about the difference between 2017 and today. If you told me Jesse Pawel was going to be the first major crypto player to get a banking license, I mean, that is the antithesis of what Jesse Pawel believed in as an early crypto anarchist. And I'm sure if Jesse saw this and watched this video, he'd be like, I can't believe David Silver, of all people, is going to talk about me becoming mainstream. But that's about probably the biggest insult I can throw his way, is he's now mainstream. He built a product. It became so large and had so much access, money, power. They're using, we quoted Peter before, Coin Center as a lobbying arm. There's so much that, when you become the 800-pound gorilla, you have to play by a certain set of rules. And whoever gave him legal advice, I'm sure, said, well, you might as well become a bank now, because you're going to be under FinCen, you're going to be under the BSA, you're going to be under all these things. And it's the wave of the future is to work with the regulators. I used to say it was Brian Armstrong at Coinbase, the Winklevi, but I've always said support people who work with regulators, because eventually, when something goes wrong, you're going to want the arm of the law on your side.
So I think one of the things I'd love to go into a little bit here is at what point on a company's life cycle or a founder's life cycle in terms of deploying a DeFi contract do they actually need to start working with regulators? Because it feels as though there's this significant, maybe not quite defined time period where I can be super innovative, I can go after stuff, I can launch things, I can break things. And if it becomes successful, then I can sort of say, well, look, I did some best effort stuff, and don't treat me so harshly.
I tell you when they make enough money to pay for the lawyers, that's the point, If you are not at this tipping point, like just go where you go, so.
The CEO of Exxon really explained this one well. If a barrel of oil costs $100 to make and you can sell it for $1,000 and you have to pay $100 fine, if your profit's still 80%, it's until the profit margin goes down to zero. You look at your profit margin to decide who you're going to talk to and play with.
Yeah, I mean, I speaking just from personal experience of working with different projects at various stages with regulators, and going in to see them, I think if you can start earlier, it's better, because what I've found is that sometimes the questions that you get from the regulators when they're looking at a project are not the ones that you would have expected, nor ones that you would have thought would be relevant under a traditional understanding of the law. So I think to the extent that you can do that earlier, if you are a project out there, with lawyers, of course, it may be very helpful in terms of developing your architecture in a way that is legally compliant from the beginning, right? As opposed to trying to go fix something where you've hardwired something that is not legally compliant. And I think even working with clients that have raised money, significant amounts of money in ICOs and others in the past, where frankly, at the time they weren't my client. But going in to talk to regulators and say, like, these are what the future plans are. By the way, this happened, and this is how it was legally compliant, right? And I think that can be done, but it often would be, in the event that someone did something at an early stage that then they later realized was not compliant, there isn't really a way necessarily to erase that, right? And so it may impede or at least color your decision-making process as to whether you're comfortable as a project or company going to talk to a regulator at a later stage. And so that's why my recommendation would be that, that earlier generally would be better, just because at a later stage, you may fully intend when you get big enough to go talk to the regulator, but if during those building block pieces, you have done things that then later you don't really want to be affirmatively disclosing, I think it can be, you're most likely with your counsel and with litigators potentially, which I am not one, you would be discussing things like whether that is in your best interest. Yeah.
I think as well, by the way, I think that, if you take any industry, any financial services industry today, define it within sort of conceptual self-executing, code on an open, decentralized network accessible to anyone in the world, and you think you can do that sort of without even considering anything, that's, I think, quite a dangerous position to be in. Saying that, if you're at least looking at the right tests. So, are the activities that you're building, I mean, what is the level of moderation that you have? What is the level of intermediation that you have? What control do the writers of that software or founders or operators have over that platform? How are you dealing with the risk? I mean, just because you're decentralized, it doesn't mean the risk is moving from the counterpart to the code. So what is the smart contract risk? What is the Oracle risk? What is the financial risk? What is the regulatory risk? If you're not considering any of those things, I think that you're also putting yourself in a dangerous situation. But unfortunately, the guidance isn't really, there is no regulatory guidance in the world as to a test for DeFi. And sometimes I've referred to the FATF guidance a few times, but they use like two super extreme examples. So they refer to a peer-to-peer trading platform outside of the scope of being defined as a VASP as a bulletin board. So that's a really simple example of something that isn't going to be shouldn't be captured within the scope of regulation. And then on the other extreme, they have EtherDelta, and they use that as a real case, and they give the breakdown where Mr. whatever it was, Mr. Coburn, and he had a token listing process and procedure. He ran all the trades on a separate server that was controlled by him, not even written onto Ethereum, etc. He didn't charge fees, but there were 0.3% transaction costs that went into this separate kind of fee account that he did control. I mean, that's pretty obvious as well. But the unfortunate thing there is that they're just too extreme. The real difficulty is the bit in the middle. So when are you falling into one trigger or the other? And I think considering those things, front ending those considerations is much easier than dealing with them at the back end of a problem in a year's time. That's what I think anyway.
So I get to take the opposite side of this because let's be clear, I don't provide advice to companies. I don't do transactional work. And if everybody followed Josh and Joey, I'd have no work. So as a process, you should follow your lawyers and do what your lawyers tell you to do. But if I was going to say what the practical reality was of what most startups did without money, they would do first and ask for forgiveness later. And that's the practical reality, because to hire the right lawyers, there were, especially in the ICO time, there were a lot of lawyers who did do some blessings on, people raising money and doing what. But there's not, use the Telegram ICO. I mean, they had scat and ARPs. This was not a company that didn't raise money and trying to do it in a legal manner. The questions that arose, even with paying the best lawyers, raising $1 billion, it still didn't work out for them in the space because because the regulators came in and basically said no. So I just think the practical reality is a lot of people are going to do exactly what Pawel said. They're going to build the moat and then they're going to pay the fine on the flip side. I mean, at the end of the day, what Kik paid in their fine was pennies on the dollar of what they raised. Again, I think there's one more big one coming out in the near future where the fine will be, as a percentage of money raised, much lower than what the penalty should be. But they're going to be astronomical numbers. It's going to be 10, 20, $30 million. But ultimately, I think it's going to be do first, ask for forgiveness later. And that's good for my business model. So I like it.
So just delving into this, and I think it's a great point you brought up, David, in terms of, the likes of Kik raising 100 mil, pay a 5 million fine, cost of business 5%. That's a pretty good deal, right? And we've seen a few others who have, engaged good lawyers and had, let's say best effort basis sort of afterwards. Have the stakes been raised a bit with DeFi? Do we have a few other risks? Because we have these markets which, let's look at these ICO guys. A lot of them, they initially didn't have users. A lot of them took in a lot of money from private investors. And let's be fair, regulators don't care so much if you're very rich and you lose money. What they care about is, my old gran losing her pension to someone. That becomes, a lot more serious. In the DeFi space, we do have this elevated risk of large amounts of financial transactions and let's be perfectly honest and kill this very large elephant in the room, zero AML. Zero AML between transactions, a large amount of people coming in on the AMMs, where you have a number of people involved in transactions, and potentially counterparties not coming from such honest backgrounds, who are coming in and trading and moving coins around. I mean, in this early stage with such high volumes of transactions, you know, is that custodial risk greater this time around than it was for the ICOs?
All right, so let me jump on this one. I think there's with DeFi there's a couple of risks. One, it's transactional, as you said. So we have, I think one big, you ask which regulator will be critical. I think one regulator which we didn't mention, or one body which we didn't mention, is Department of Treasury and OFAC list, and terrorist financing. That's, I think it's a huge risk for this sector, because there's no control whatsoever. It's very, very transactional, so you can actually transfer without any control from different counterparties around the world very, very quickly. So that's one. The second part is, as we could see from like KuCoin hack and etc., almost every hack right now is being transferred through DeFi's, right? Like, it's happening. It's there's no way you could do this in this amounts with, I don't know, Coinbase, right? So that's something which is happening for sure, and that's huge risk. And I think there's 2 points I'm bringing to the third point, is that it's actually that DeFi could be the systemic risk for crypto sector. I think this could be actually the regulators saying, okay, there's too much risk, it's outside our control, we shut this down. And I think this is potentially something which can be a risk for the entire sector.
Yeah, I think though you just on the point there, because it is interesting, and it sort of ties in with what I was saying earlier about sort of approaching this from the right way and the right standard. So in the KuCoin example, where there's a hack, etc., and effectively a number of DeFi or DEX platforms are used as mixers, there are platforms that can be used in that way, but from what I understand, there are other platforms that can't, where the sort of inputting address to a decentralized exchange platform is always the outputting address. So you can always trace the activity that's happened relating to that particular, and even the transactions that happen underneath that, I think. So if you're allowing that to happen in the right way, arguably you're trying to guard against that, and if you're not, then arguably you're facilitating it. So again, how you're building this and what you're doing is very, very critical. But again, how regulators look at this is also extremely important, because if in the example of the DeFi platform we was talking about related to the KuCoin hack, if they had been building, if they'd been focusing on not the regulation of an entity or platform, they focuses on the freedom of the individual, etc. But those decentralized platforms have been built bearing that specifically in mind. I think that the risk would go down, and I think it would be less of a target for enforcement agencies and authorities. But the further away, there are going to be standard setting bodies and entities that are approaching this the right way, and there are going to be others that don't, and the ones that don't are the ones that are going to create, or could create, the sort of baseball bat scenario where it's just a complete shutdown of everything, and that's something that we hope the industry can start to see and react to, I think.
One thing, just based on what Pawel said, I mean, just to touch again on OFAC, things like that, just in very candid conversations, not, with large projects in the space, one of the things that seems to be, at least for projects that have done some sort of regulatory analysis, that they realize is, okay, well, we might have a principles-based reason for why we think, securities laws, U.S. securities laws are not applicable, or for why we think, okay, this FinCen thing is really a BSA thing. Whether this is right or wrong, what I've heard generally though is, look, the OFAC stuff, there's no way out of it, right? And so some projects are geo-blocking certain locations, even if there's not like a robust protocol level or any protocol level KYC or even application level KYC being done. So obviously we all know we know that geo-blocking is not is not a perfect.
Yeah, exactly. Josh, I
solution.
think that's the point with the whole, like, yes, they are very concerned with OFAC and terrorist financing, all this stuff, but no, they don't do KYC. I mean, that's not like you can remove KYC and be OFAC compliance or block terrorist financing. That's not something. And I think many of the projects, yes, they are concerned, but they do nothing.
Fair enough. I mean, David, do you have any comments on this side? I mean, obviously you take more sort of the angle of looking to reclaim. I mean, having DeFi as mixers, is this, making your job more confusing? Is this making the time having to work a case a lot harder? I mean, a centralized exchanges starting to push back on this, because I imagine at the moment they're taking on quite a lot of endemic risk because they're actually providing a lot of liquidity with it across these DeFi protocols. If you had any instance of them being not so happy about funds coming through various DeFi protocols which aren't putting these checks in place, which they have to have there.
So I think what we're talking about is, moving towards the future. The travel rule is going to be a very important rule. Knowing where money is coming from and going to, like how banks are required to know that information. Cryptocurrency exchanges, centralized and decentralized. If you take even from, I don't care if people say they don't take custody, they do it through a smart contract. They're going to be required to know where the money's coming from, who the money's going to, and allow firms like CoinFirm to break through that wall when given the correct information to do an analytic analysis of where the crypto is moving. And I think that's the wave of the future, is using analytic analysis, providing that the exchanges, whether centralized or decentralized, I don't think the governments are going to care whether you're decentralized or not. They're going to say, if you're not getting this information, you're going to be held accountable. And I think that's kind of the BitMEX theory. The government really didn't care that a CEO who went to Warden, who didn't surrender his US passport, was living in a country or operating out of a country that I can't pronounce or spell. He was using American funds. He's an American citizen. And if they're not doing proper KYC and AML, the governments aren't going to allow it. So I think the wave of the future, whether decentralized or not, is the information collected is going to become more, and it's going to be used by regulators, firms like CoinFirm. And this goes back to my good friend Jesse Powell. Why did he create a bank? Because at this point, running an exchange, the KYC and AML requirements are no different from an exchange, a crypto exchange, to a bank. And that's going to be the wave of the future as far as I'm concerned, which is, if you do it correctly, bad for business for me.
Yeah. It's also, I mean, it's just funny because you mentioned the travel, David, and that's super interesting. But again, it's another, it's another question of, I mean, the travel, that rule will apply to a VASP. So if you are falling within or outside of the definition of a virtual asset service provider, and if you look about a contract, not the sort of provider of the contract, the operator of the contract. So could you have a smart contract that is non-custodial, where the smart contract takes control of the assets and it's not considered to be a regulated virtual asset service provider? Or are you exercising control over that smart contract to a level that you are considered to be a VASP? If you start to apply waves of requirements, let's say the travel would be one of them, it becomes an even more important question as to whether regulatory authorities are bringing that activity within the scope or outside of the scope of regulation. And it goes back, I mean, travel goes beyond that to all the other complications, unhosted wallet related transactions and everything else. But it is a really, it's such a critical factor for groups and developers to consider. And the worry that I have is that some of them are considering that, but some of them are not. And I suppose what we all want to avoid is the 2017 repetition where this is just branded as a problem. That's I think what we want to avoid.
I think you're right, Joe, to bring that point up, because it does feel like we're in a bit of an echo chamber again. This does get banded in with the ICO crowd, although it does seem very, very different. There are users for one, and it does actually seem, if this was something where this was able to become more mainstream, you are actually providing something which is in the benefit of users. You're eliminating rent seekers. You're making things more open, more transparent. You're making less non-custodial risk, which is something I think gets lost in this conversation. That there is actually, in some areas, less risk by transacting within this manner. And you'd hope that regulators would sort of react in this way appropriately. One question that we got from the audience, which I think is quite relevant. So Mikhail asks us, so what happens in the case where fees are going back to liquidity providers? So within these kind of AMMs, sometimes in one transaction, you might have thousands of people providing liquidity, a fee for that transaction to take place for a swap or what have you, and then that going back to those, let's say, governance token holders. How do you think regulation applies to this scenario, which is completely new, all designated by code, and kind of hard to stop? I mean, are there any liabilities that you see with these token holders taking on individually? So some of these funds providing liquidity, individuals providing liquidity. Do regulators even know where to start with this, let's say, completely new scenario?
I think if I would be starting, if these guys are somehow liquidity providers, somehow connected with the team who is, also influencing development of the protocol, that's the one-to-one connection. This is how you can connect those dots. If something is like bona fide, liquidity provider using the protocol the way it's actually structured, that's probably less of the risk.
It also can be subject to, I mean, it's a very interesting, so as a concept, as one of many concepts, and just putting it all under the DeFi umbrella, or that some people say, well, because we're decentralized, we have no we're not an incorporated entity anywhere. There's no counterpart to any of these arrangements. We're not subject to law anywhere in the world because because we are decentralized. Unfortunately, the flip side of that argument is sometimes what people forget, which is, conceptually, you're subject to law in every single jurisdiction in the world, and any authority can take a view as to how they interpret that arrangement. If you have a user from that jurisdiction or whatever it might be, that is also, it's something that could potentially happen as well. So the question is, if you are asking that question to one lawyer in one jurisdiction, you might get answer A, and if you ask it to 55 lawyers in 55 jurisdictions, you can have very, very different answers, and that is a risk. So yeah, I think the efforts, I think the concentration should be on the underlying technological infrastructure. So really to tie everything in an appropriate way together to be operating to the right standards. But that's a difficult question, Ryan. You want to
So I'll give a practical answer, and then Josh will give a legal answer. So the practical answer is, if you take money, and I consider crypto money in this question, if you take crypto, you are going to be held legally liable for anything you take. The moment you accept cryptocurrency as either a form of payment or as a form of security, whatever you want to call it, doesn't really matter. If you accept payment, you are going to be held liable. Now Josh will give an eloquent legal answer.
Josh, just one point. Josh, one question to you, one addition. So what about investors who put money into these structures and part of the initial investments? Do you think it's going to be liable in this way?
I mean, so when you say investor, I realize this question is for David, but what do you mean by investor?
When we talk about compound, let's say, and then we have Andreas Horowitz investing, and Bain Capital, like good brands, and then they putting something which is like, let's say, not 100% compliant.
Oh, Josh, you want me to take that one?
I mean, we can both go for it. You want to?
No, go ahead. I'll do it after you.
I would say, like, I would echo some of what Joey said. Like, a lot will depend also upon the various jurisdictions. I mean, some jurisdictions will have extraterritorial reach potentially, right? Like the U.S., for example. In many instances, there, as long as U.S. people in the U.S. are involved, where there's some sort of nexus, there may be, extraterritorial application of U.S. laws in certain instances. I think it's hard to say exactly what, just because you may have an investor, because the investor could be investing in myriad ways, right? They could be providing capital in the form of, purchasing tokens. They could have made some sort of equity investment in a vehicle, that was used initially to fund. So it's difficult to say. I will say people should be wary, and this is not legal advice, any of it. But I do think one thing that may also be relevant is whether you are doing this as part of your business, right? Or whether you're just a user, acting in your own personal user capacity. But I agree with also what David said generally, which is that if you are accepting crypto, you need to become aware of what your legal responsibilities are. And I think it's even more of a reason why the community of good actors, right? We're not talking about people who are trying to use these projects or participate in them because they're trying to finance terrorism or something like that. But good actors don't want to have legal liability, right? And so maybe this is a reason to encourage, well, no one wants to have legal liability, but maybe it's a reason to encourage projects to hardwire in things like KYC AML.
So I'll give a practical example of an investor who got drawn into a lawsuit. And that would be Tim Draper and Tezos. So he was a large investor in Tezos. When the Tezos class actions got filed, I filed the first federal class action. I did not name Draper, but someone who filed subsequently in one of the class actions filed against Draper and his associates. So the answer is yes, investors are going to get tied into some of these lawsuits. Now, one of the reasons Draper got tied into the lawsuit is because not only did he invest, he openly spoke about his investment and tried to attract other investors. So a lot of this comes down to, and if anyone's ever seen a Silver Miller complaint, I'm a big fan of using tweets, Slack channel discussions, Discord, Facebook, Twitter, but any type of social media proclamations an investor makes on behalf of the company or his investment, trying to draw in more to drive up the value, then there's a lot of exposure out there for people that they may not necessarily think applies.
Yeah, and one other thing I'll just say, and I defer to David and others about this, and I apologize for the background noise that is outside my window. But in general, I mean, unless you have some, I mean, it's very difficult to avoid being sued, right? Like someone can almost always sue you. So just because you may not ultimately have liability doesn't mean that if you have deep pockets or are, potentially, someone from whom somebody could receive a large recovery or a meaningful recovery, even if the original team could not provide such a recovery, it's just something to be wary of.
Yeah, and the other, just very, very frank, because it relates to Ryan's question indirectly, and Josh mentioned the sort of extraterritorial reach of some jurisdictions, but there are other, I mean, there are tests. I mean, there are, even if you're not servicing someone from that jurisdiction, I mean, if you look back at the sort of tax universe and you start considering questions around whatever the place of effective management or permanent establishment or whatever it might be, just because you're operating something that you deem to be a decentralized operation, the majority of those applications, they can be very dependent on whether it's a kill switch or some form of centralized oracle or some centralized support or maintenance. If you're effectively managing that from jurisdiction A, B, or C, it's more, there are things that can be considered. The tests don't yet exist, but I think they are going to develop.
Very good. I realise we're coming up just over an hour, and I know you guys have various things to rush off to because you sit on many different boards. I wanted to finish just with maybe one last question, just to put you on the spot because it's fun. Obviously, in crypto, we kind of go through dog years. 1 year feels like 7. Everything moves so quickly. I'd love to get a viewpoint from each of you of where you think the DeFi space will be in the next 2 years, and what are going to be the major pointers there. So I'll start with Pawel. Why not? Where do you think we'll be in 2 years, Pawel?
Yeah, so I think we're gonna have some major players who are doing the regulatory arbitrage, kind of ring fence with good lawyers and doing this in a number of different jurisdictions. Then you're gonna have DeFis who are, we doing this full speed, with compliance aspect, with all regulatory, OKs and etc. And then we're gonna have, Wild West, which is basically, like new protocols, new things, which are, more DeFi than the DeFi which we know right now. And I think this is gonna be, so you're gonna have the most innovation happening in this, new space. But I think it's going to become much more civilized area.
Very good. Joey, how do you think it's going to pan out in the next couple of years?
I think it'll be. I think that the technology or the principle is here to stay, and there'll be an emergence and development of standards, and the advanced groups will emerge and operate to those standards, and the other end of the spectrum will come under more and more pressure. So I think it will continue to exist and develop and develop to the right way. And by the way, I mean, you asked us at the beginning, and I just literally saw a note that I jotted in. I think it was wording, and it was Lee Schneider's wording, when he asked. I think he was describing sort of decentralization. He used 3 words. I mean, middleman to middleware. That's the concept that we're all behind and backing. Great definition.
Fantastic, brilliant. David, where do you see this going in the next 2 years? How many clients will you have in 2 years' time?
So I think the answer to that is there's going to be a lot of fraud in DeFi, and a lot of money is going to go missing. I think that's where CoinFirm is going to really earn their money, is if they can track the assets, because part of stealing money is being able to off-ramp it for USD. And there are only so many places in the world you can off-ramp for USD. Right now, we have lawsuits we're suing CoinCheck in Japan, Indodax in Indonesia. We tend to focus, obviously, on the US exchanges. I did the list before. So ultimately, I think there's going to be a lot of it, but this is going to be one where liability is going to be strong. Collectability is going to be the issue. So it's going to be the ICO mess all over again for guys like me and my clients who, let's assume Bitcoin goes to 100,000. They all will think they're incredibly wealthy, and they're all going to find out that they have nothing to actually tangibly touch.
Very good. And then Josh, you'll probably have a slightly lighter, more optimistic viewpoint, I'm hoping, to finish everything off. So what's going to happen next in the next 2 years?
Well, I think if history is any teacher, a lot of projects will fail and some will thrive, right? And some, just as David noted earlier, that may seem a little bit edgy right now, may turn into the most mainstream projects we know. Moreover, I think if we look back, in order to look forward, if we think about digital assets and how they were thought about in 2016, 2017, right? And now we see other mainstream large, household name companies engaging in exploration or in commercialization of digital asset related projects and services. I think we'll see some of the same. I mean, it may sound kind of strange to have like a large brand, doing something that is DeFi, but I think we'll somehow see it. And I think also what we'll see is in a couple of years' time, some other new catchphrase, new category, where people have come up with more and different ideas, and we'll be asking similar questions about how that fits in. But I think that's like the magic of innovation and technology.
Fantastic, brilliant.
And I think we all paint, really good picture, because this means what we are saying, that in number of years, I mean, like in 2 years, we're gonna see a lot of companies, multi-billion companies in the DeFi space. That's given.
No, absolutely. Well, I think we can end on those mostly positive points. I'd just like everyone to thank everyone again for joining us. I think that's been a really fantastic discussion. I always ask this: are you guys okay for us to share contact details within the emails out after the webinar? So if people can use your obviously clear expertise within this field, they can reach out. Are you okay with that, or go one by one?
Absolutely.
David has too many clients at the moment.
I'm just reading the questions. I'm going to answer the last question that was just asked. Cred, I have spent the last 5 days talking to every major investor who invested in Cred. Yes, there is. Cred is the stories I've heard about Cred are it's everything wrong with crypto. I hope it's not true. Obviously, I believe a lot of what's being said by the former employees is true. The bankruptcy filing is, let's just say, illuminating. And give me a call, send my details, silvermillerlaw.com. Anyone's got a question, I'm always happy to talk about it. But yes, I mean, Cred is a perfect example of something in crypto that looked incredibly legitimate up until about a week ago.
Fantastic. Well, thank you for that insight. And of course, we'll make sure, as long as we don't have any objections or very strong legal letters from any of the panelists, we will be making this available online within the next 24 hours or so. So again, thanks so much for taking the time out of your days and joining us. And I'm sure it's a discussion we'll continue to have over the next few months. Again, thank you.
Thank you, Ryan. Thanks, everyone.
And it's wonderful to be here with all of you.